Are you investing to build a more secure future for your family and yourself while you're lowering your taxes on those investments? If so, you are in the right place. In this video, I want to share with you 6 strategies with examples that will help you reduce your taxes so you can keep more of that cash. Now let's get started. Hello, my name is Sonia Narvaez. I'm a licensed CPA. To start things off, let's get started with tax saving strategy number 1. And many of us have heard of retirement accounts, like contributing to a 401k, IRAs, and defined benefit plans offer a really good bit of deferred growth and for sure will lower your taxable income. If you work for an employer, you can contribute up to $23,500 in 2025, and that is all tax-free. Now, for my small business owners watching today, I suggest you consider a defined benefit plan. Now, let's understand first what a defined benefit plan is. A defined benefit plan is unique in that it exists on the company's books and not in the owner's names like a traditional retirement account. As I said, it operates like a pension plan. It will provide a stated annual benefit at the time that you retire. This benefit is usually based on the years of service. It can also be based on a cash-based formula. One of the great things about a defined benefit plan is you don't necessarily have to work a ton of years for your company to be able to start one up. Now, to understand how the benefit is calculated, the contribution amount is usually calculated by actuaries in collaboration with a financial planner. They will consider key factors. It's going to be your payroll, how much money you're doing through W-2 income, is going to take into consideration your age and the number of years before you retire. If you are a business owner, you can take the opportunity to contribute to a retirement plan based on the maximum allowable benefit under IRS rules for 2025. This is huge. The maximum contribution per employee for 2025 is $280,000. Now, to understand this better, let me give you an example, and I'm going to use one of my clients to make it more understandable. One of my clients who had a business, and a lot of my clients just don't contribute to the retirement plans. They have a lot of cash flow issues earlier during the years of getting the business rolling. But now he's in his late 50s, and he had not started a retirement plan. He has an S corporation. The S corporation generated income of $200,000. Now, as a single person, my client was going to pay $41,063 on this income. Now, what we do is we set up a defined benefit plan, and he contributed. He was already behind on retirement savings, so he contributed $200,000 towards this retirement plan, completely eliminating the $41,000 in tax that he was going to pay for. Now, the best part about it is that most clients use the money during the year, right? But with a defined benefit plan, you don't have to fund the whole $200,000 by December 31st. So you have until the extension. You can file an extension, and as long as you fund it by the extension time, this will make a huge difference because some people don't count having $200,000 in the bank to put this money away. Now, by having this additional time, it allows us to watch cash and grow it. So by the time that the extension takes place, we can contribute, and we have deposited the $200,000 into a defined benefit plan. I really like this particular retirement benefit, especially when my clients are in their older age. So before I give you tax saving strategy number 2, I want to share with you about 6 different benefits of how a defined benefit plan is going to make a difference to you. Benefit plan number 1, tax deductions. As you can see, and then based on the example, you could see what kind of a difference it could really make to your bottom line. You do not give all that money to Uncle Sam. You keep it for you, for future use. Benefit number 2, accelerated retirement savings. Think about it. My client was in his 50s, late 50s. Now he needs to really start putting money away. With this, it allows him to put so much more money at once while saving a good bit of money in taxes. Benefit number 3, employee retention and motivation. Your employees will be very happy to stay and be more loyal when you are providing something that is this good for eventually when they retire. Benefit number 4, it's customizable to your needs. It can be tailored to prioritize benefits for the owner while offering meaningful contributions to employees. Benefit number 5, estate planning and legacy. Just think about it. If you're no longer around and you've got all these accumulated funds, you can secure this retirement income and leave this for your heirs. And this could be one of your financial legacies to your family. Last but not least, benefit number 6, mitigates investment risk. So you're the plan sponsor. Your business will fund the plan. The benefits are really predetermined. Like I said, like a pension. There is a predictable income in retirement, and you certainly will avoid the uncertainty of relying on just market performance, which is in most other retirement plans. In short, a defined benefit plan allows you to contribute tax efficiency with accelerated savings, making it an excellent choice for business owners who want to secure their financial future while benefiting both the company and employees. And remember this, as an S corporation, my client had until September 15 to make that final contribution to the plan. Just think about cash flow and what it's going to do for you. You will not have to pay taxes, yet you get to keep all of it for even longer period of time until you retire. Okay, so let's talk about tax savings strategy number 2, health savings accounts, also known as HSAs. And these are one of my favorites. And the reason why is that they are one of the few tax strategies that actually provide like triple tax savings. With HSAs, contributions are tax deductible, earnings grow tax-free, and withdrawals for qualified medical expenses are also tax-free. So let me give you a practical example of how an HSA will work on your taxable income. Let's say that your taxable income as a single taxpayer is $60,000 and you contribute $4,150 to the HSA. Now your income is going to be reduced to $55,850 by making this contribution to your HSA. Now, what does that do? That is going to save a single person $607 in taxes. You could use this money for any kind of qualified medical expenses, doctor visits, prescriptions, going to the dentist. Each year, the amount you can contribute normally goes up because the IRS increases the savings limits based on inflation and other factors. It's also worth noting that any unused balances can continue to grow. You can leave it year after year and use it as a planning tool for maybe a future surgery, braces for the children, and things like that. Tax savings strategy number 3, municipal bonds. In the world of investment, it's common to hear options like 401ks, HSAs, Roth stocks, precious metals, you know what I mean. So there is one tax-free option that a lot of people miss, and that is municipal bonds. Now, what's so unique about municipal bonds is that it provides a tax-free interest income, and this often makes them very attractive, especially for individuals with higher income. This is how normally they work. I'm going to walk you through an example. So an investor purchases $50,000 of municipal bonds. Now, let's say that the annual interest rate on the municipal bonds is going to earn you 3%, which is not a lot, but you make $1,500 tax-free in income annually. Now, let's assume that you did that for 20 years. That would earn you $30,000, assuming a very low interest rate of 3%. And this is going to be income tax free while you're still maintaining your $50,000 initial investment. Not only is this income going to be exempt for federal taxes, but in some states, taxes will be exempt. It will also depend on the bond issuer. So it's good to check into it, but this is a great way to invest your money in tax-free investments. Tax saving strategy number 4, one of my favorite ones, real estate investments. So real estate investments often scare people off because they feel like they can barely afford their home they're in. Many times, little they know that by investing in real estate, they can receive substantial tax advantages. So here's an example of how purchasing real estate as an investment can play out. So you are the investor and you buy a $300,000 rental property, and let's assume you rent it for $2,000 a month. You are going to make $24,000 in rental income for this particular year. Now, let's talk about the deductions that you have against this $24,000 income. Number 1, usually the best one, is depreciation. Now, we can depreciate the home based on $250,000, not $300,000, because we got to remember that land is not depreciable. This depreciation gives us $9,091 in a deduction against the $24,000 of income. Now, let's say that you had a mortgage and you paid an interest $12,000. Now, you also deduct the $12,000 in interest that you paid for the year. Now, you have other expenses like property taxes, repairs, general cleaning, maintenance, various things that are going to go on when you have a property for rent. And let's say they amount to $6,500 for the year. This also is fully deductible. So the total deduction of all these expenses I just went over is $27,591. Now, if you remember, we made $24,000 in rental income. So that gives us a paper loss of $3,591. Because remember, you got the money coming in and you spent it out on many things, but what really gave you the loss here was the depreciation. Now, that completely offsets the income which you did receive. So what is this going to do? It's going to really lower that taxable income. And in reality, you've brought money in. You haven't really spent money out. Now, let's do another scenario with the same house. Let's say that we sell the property, you keep it as an investment, you've made all this income during these years, now you're tired of it, you want to upgrade, or you just want to sell it. How is that going to work? Let's say the house now, your $300,000 house, not sales for $450,000. This is going to give you with a minimum of $150,000 in capital gains. What we have to remember that there is a way of avoiding taxes completely on this $150,000 gain. And what we will do is we'll use Section 1031 exchange. And this will allow us to take all the proceeds, including the gains, from the sale of this property onto another property completely tax-free. And this is one investment on property that can really make a significant difference to build wealth. Tax strategy savings number 5, it's tax loss harvesting. And to make it easy to understand, it's just tying your good income winners with your losers. So here's how I'm going to give you an example. Let's say that you're an investor and you got some stock that's your winner and made $5,000 in capital gains. Now you have other stock that you've had it for a while, you know it's going nowhere, and if you sell it, then one is going to offset the other. And basically, if you have a $5,000 gain in one and a $5,000 loss in the other one, they offset each other, you got zero capital gains. So here's another example of how tax loss harvesting works. So let's say that you have the same situation, you had made $5,000 in capital gains, and now you need to offset the $5,000 capital gains, but instead of just selling a stock that is equivalent, you sell a stock that is has a higher loss. You know it's not going to do any well. You know holding to it is not good. So now you want to offset your capital gains so you end up with zero taxable income regarding to your capital gains. So what are we going to do? We're going to take the $5,000 gain. We're going to take the $10,000 loss, and that gives you with an additional loss of $5,000. Now, because it's passive income, we cannot write off $5,000 on top of the gain that we offset it. We can only deduct $3,000. However, you can carry forward the $2,000 to the following year. Please remember, if you're going to a new tax professional, if you are doing it yourself, if this is not saved properly, the carry forward strategy, you can really get burned because many people forget or do not provide all the schedules of the carry forward capital gain losses that stay with you until you completely run out of those losses. So make it a priority. Provide the tax return with all the supporting schedules. If you're switching accountants, most accountants should have a history of your carry forwards if it's the same one. Finally, to our tax saving strategy, number 6, charitable contributions. Do you have a favorite cause, a church, a nonprofit organization? Charitable donations to a qualified organization are yet another to use strategies to reduce your taxable income while supporting your cause. So let me give you 2 examples of how this will work. Let's start with a very simple one. First, you contribute $10,000 to your local charity that you really like, and you're in the 24% tax bracket, $2,400 you're going to save in taxes. Now, that is a pretty good move. You've accomplished a couple of things with that. But what about if there's even a better strategy that will cost you less? So let's say that you invested $5,000 in stock, and now you want to donate the stock to your favorite charity. But when you bought the stock was about a year ago. It's been a couple years, 2 or 3 years. You even forgot about it. You just really want to lower your tax liability. And now you want to sell the stock, and the stock is worth $10,000. That is the fair market value of the stock. Now, you can donate. Remember, it originally cost you $5,000. Now it's worth $10,000. You donate the $10,000 of that stock. Now you spent $5,000, but you get a $10,000 deduction. At the 24% tax bracket, if that's where you're at, you would save $2,400. You invested less money, yet got the same benefit. Everybody wins. Now, please remember, these strategies, when tailored to your specific individual circumstances, can provide a significant tax savings. This will certainly help you achieve financial goals, your particular financial goals, whether it's through reducing your income, leveraging deductions, deferring taxes. Consult with a financial planner, a tax advisor. It is extremely essential to maximize these benefits. Every situation is different, with different goals and different ways to attain a certain result. So I hope you have found this video helpful, and if you follow these 6 strategies closely, you will for sure lower your tax bill. And if you have any questions about how to take advantage of any of these saving strategies, book your free estimate with a member of my team. Click on the link below and pick the time that works best for you. We would love to help and meet with you.